Imagine waking up tomorrow morning. You make your coffee, you reach for your phone, same as every morning, and you see a headline you have never seen before in your lifetime. COMEX cannot deliver silver on open futures contracts. Not a rumor, not a fringe newsletter, a real wire service headline. Your entire understanding of your silver stack, your financial position, your savings changes completely. I don't want to scare you. I want to prepare you. A COMEX default does not appear from nowhere. It telegraphs itself. It leaves data fingerprints in the market weeks, sometimes months before. If you know the 3 specific signals, you will not be the person reading that headline with your mouth open. You will be the person who saw it coming. Channel intro, I'm the stack guy. This is not a doom video. It is not a prediction. By the end of this video, you will understand how COMEX works, what a default looks like, and the 3 data signals that precede extreme delivery stress. To understand where we are today, you have to understand how COMEX actually works. COMEX, the commodity exchange, is the primary futures exchange where silver, gold, and copper are traded. It is owned by the CME group. And when you hear about the silver price on any given day, that price is almost entirely determined by what is happening on COMEX. When someone buys a silver futures contract on COMEX, they are agreeing to purchase 5,000 troy ounces of silver at a specific price on a specific future date. The overwhelming majority of COMEX silver futures contracts are never settled with physical silver. Approximately 98% are cash settled. This is completely legal. It is how futures markets are designed to work. Futures were originally invented for farmers and grain buyers who needed to lock in prices. That remaining 2% of contracts, the ones where someone actually demands physical delivery, require COMEX to produce real, vaulted, registered silver bars. And the amount of silver in those vaults, specifically the registered silver, is the number that matters most for understanding default risk. Eligible silver stored in approved vaults but not committed to delivery. Registered silver formally designated as available for delivery. This is the number that actually matters. Now, when registered silver gets low and the number of standing contracts approaches the amount of registered silver available, the system comes under stress. A COMEX default does not begin on the day of the default. It begins weeks or months earlier with a demand spike, a sudden increase in delivery notices. A delivery notice is a formal instruction from a futures contract holder saying, I don't want cash settlement, I want the actual silver. If a large institutional player decides to stand for delivery on a large number of contracts simultaneously, the vault system comes under sudden pressure. This is not illegal. It is not manipulation. It is the system working exactly as designed. Standing for delivery is simply exercising a contractual right. COMEX and its vault operators will immediately begin trying to source additional silver, reclassifying eligible silver to registered status. Now, sourcing silver from the London OTC market, the LBMA, emergency transfers between London and New York vaults happen during stress events. Negotiating cash settlements at a premium, paying holders more than the contract price to take cash instead of silver. This is the pressure valve. If the inventory scramble fails, COMEX has another tool available. It can change the rules. COMEX can amend delivery rules, allow expanded exchange for physical substitutions, allow silver certificates instead of bars. In extreme cases, declare force majeure. In March 2022, not on COMEX, but on the London Metal Exchange, the nickel market experienced exactly this sequence, a 250% price spike in 48 hours. The LME suspended trading, canceled billions in already executed trades, and imposed position limits overnight. Legitimate traders who held profitable positions had those trades canceled retroactively. If you held long silver futures, expecting physical delivery, and COMEX declared force majeure, you would receive cash at the last official price before suspension. If silver's paper price was suppressed below its true physical scarcity value at the moment of suspension, that cash could be at a price significantly below what your silver is actually worth. This is why understanding the signals matters. Not to predict when this happens, but to understand your own position before it does. In a genuine COMEX delivery stress event, the most visible signal will be a decoupling between COMEX paper price and physical silver premium. In March 2020, physical silver premiums on American Silver Eagles temporarily hit $8-12 per ounce above spot, even as the COMEX paper price was falling. The physical market will always find its true clearing price. COMEX can regulate paper. It cannot regulate the price where a private buyer and seller agree to exchange physical metal. A significant sustained premium explosion in the physical market while the COMEX paper price remains flat is the market telling you something the official price system is not admitting. Now we get to the core of this video, the 3 signals. Now, these are not my opinions. These are data points that are publicly available, updated daily, and have historically preceded periods of extreme COMEX silver delivery stress. Signal 1, the registered to open interest ratio, the coverage ratio. Registered silver divided by open interest. How many ounces of committed silver exist for every ounce of silver that could be demanded through open contracts? Under normal healthy market conditions, the coverage ratio is comfortable. The system has enough registered silver to handle even unusual delivery demand with room to spare. In early 2021, COMEX registered silver inventories stood at approximately 150 million ounces, a historically comfortable cushion. By late 2022 and into 2023, registered silver had fallen to levels approaching 30 to 40 million ounces, a decline of over 75% from the peak. If open interest remains constant but registered silver drops by 75%, the coverage ratio collapses. The buffer between normal operations and delivery stress shrinks dramatically. Where to monitor this? CME Group publishes COMEX vault inventory data every business day. It is free. It is updated daily. CMAgroup.com, markets, metals, silver, inventory. When registered, silver falls below 30 million ounces. Watch carefully. Below 20 million with high open interest delivery stress becomes mathematically plausible. When the coverage ratio drops below 10%, registered silver covers less than 10 cents of every theoretical dollar of open delivery demand. You are in historically extreme territory. I'm not going to tell you what that ratio is today, because by the time you watch this video, the number will have changed. Go look it up right now after this video. Write it down. Signal 2, the EFP spread, exchange for physical premium between COMEX and London, the stress thermometer. Under normal conditions, there is a predictable price relationship between COMEX silver futures and the London OTC spot market. The two markets are deeply integrated. Exchange for physical EFP allows a futures contract holder to swap their paper COMEX position for physical silver in the London market. The bridge between paper and physical. Under normal conditions, the EFP spread is small, typically just cents per ounce, reflecting shipping costs, insurance, and financing. But when physical silver becomes genuinely scarce, when real delivery demand is straining the system, the EFP spread widens. In March 2020, the COVID market dislocation, the EFP spread for silver blew out to several dollars per ounce for several days. The EFP spread was screaming a warning that physical and paper prices had decoupled. The spread normalized as the system restabilized. In a genuine COMEX delivery crisis, the EFP spread would be the first institutional signal appearing before news reports, before retail premium spikes, before any official statement. A practical proxy. Track the difference between COMEX front-month silver futures price versus LBMA silver spot price. Any sustained divergence over $0.50 for 2 consecutive days warrants attention. A divergence exceeding $2 per ounce lasting multiple days is a serious stress signal. Signal 3, the physical premium explosion, the market that cannot lie. While physical silver premiums are the most honest real-time signal of physical market stress available to retail investors, publicly visible every day on major dealer websites. Under normal conditions, American Silver Eagles trade at 3.5 per ounce above spot. Generic rounds, 1.50, 2.50 above spot. These are the baseline numbers. Memorize them. In March 2020, COVID market dislocation, Silver Eagle premiums spiked to $8.12 per ounce above spot. Several major dealers sold out and suspended orders for weeks. January, February 2021, Reddit Wall Street bets. Silver short squeeze, Eagle premiums hit $12.59 per ounce above spot within 48 hours. U.S. Mint suspended Silver Eagle sales. In both cases, the physical premium spike was a leading indicator. The stress in the physical market appeared before any official acknowledgement, before any COMEX statement. The physical market knew first, because the physical market cannot lie. It can only clear at the price where a willing seller and a willing buyer agree. The 3-dealer rule, APMEX, JM Bullion, SD Bullion. Check Silver Eagle premiums at all 3 simultaneously. Once a week, calculate the average. If that average premium exceeds $7 per ounce above spot for more than 5 consecutive business days, something structural is happening in the physical market. If it exceeds $10 per ounce above spot for more than a week, combined with signal 1 and signal 2 moving in the same direction, that is a convergence of all 3 signals simultaneously. The 3-signal convergence registered inventory falling, plus EFP spread widening, plus physical premiums spiking most maximum stress condition. Why this matters more now than at any point in the past 20 years. The petrodollar series context as dollar confidence erodes. Monetary demand for all precious metals increases. Gold runs first, silver follows. Central bank gold buying 1,037 tons in 2023. The signal that monetary reawakening is real, not theoretical. At the same time, the energy transition has locked in decade-long structural silver consumption from solar alone. You have monetary demand rising, industrial demand rising, COMEX registered inventory declining, mining supply flat, a paper futures market still setting the global spot price. I am not predicting a COMEX default. I want to be unambiguous about that. If you have lived long enough to watch 2008, 2000, 1987, you recognize what it looks like when multiple structural forces converge on the same point at the same time. The three signals I gave you are your early warning system. Use them. Know what you own and in what form. Not all silver positions behave the same way in a COMEX stress event. Physical silver you hold personally in your possession or in a private non-bank vault is the most insulated from COMEX default risk. A COMEX rule change cannot reach your physical silver. Silver ETFs, particularly SLV, are more complex. Know your ETF's custodian. Read the prospectus carefully. Silver futures contracts understand that in a force majeure scenario, you may receive cash settlement at the last official COMEX price. Your delivery right exists until it is suspended. Silver mining stocks. Equity instruments subject to broader market forces, management risk, and operational exposure. They do not directly represent physical silver. Set your monitoring schedule. Once a week, Monday morning and Friday afternoon. Check 3 data points, 5 minutes. That is your complete monitoring protocol. Decide your threshold in advance, not in the moment of the event, now in writing. Because in the moment of a genuine market stress event, emotions run at maximum intensity. Prices are moving fast. Headlines are alarming. Forms are chaotic. The investors who navigate stress events well are the ones who made their decisions in advance, wrote them down, and execute the plan they set when they were calm. Signal 1, current reading COMEX, registered silver inventory has declined significantly from its 2021 peak. The trend over 24 months is the story, not any single day's number. Signal 2, current reading. No sustained anomalous EFP spread recorded, consistent with early stage monitoring territory, not crisis territory. Signal 3, current reading silver eagle premiums running $3 or $5. Elevated from pre-2020 norms, but not at crisis levels. No 3-signal convergence currently present. This channel will update these 3 readings in every relevant future video. I will not selectively report. I will not move the goalposts. If the signals normalize, I'll tell you. If they deteriorate, I'll tell you. Before you close this video, 3 things. First, I need your signal readings in the comments. Go to cmegroup.com. Right now, look up the current COMEX registered silver inventory. Come back and drop that number in the comments with today's date. The act of actually going to look it up is what transforms this video from content you watched into a monitoring practice you run. If this level of analysis is useful to you, subscribe. Not because I need the number, because this channel operates on a specific premise. You deserve the same structural analysis institutional investors get. There is one specific ask. If you have a spouse, a sibling, a friend who holds silver in any form and doesn't understand the difference between registered and eligible inventory, send them this video. Not to alarm them, but because the monitoring framework I just gave you takes about 10 minutes a week to run, and there's no reason the people you care about should be flying blind over terrain that matters. I'm the Stack Guy. Stack smart. Stack with data. I'll see you then.